Liquor contract manufacturer Associated Alcohols and Breweries reported a mixed set of earnings in the third quarter of FY22. Revenues inched up marginally, but net profits were under pressure due to higher input cost. Q3 sales rose 8% YOY to 165 crores as the higher volume offtake was partially offset by dip in ENA realization. However, the operating profits declined 25% YOY as EBITDA margins shrank by more than 700 basis points. The compression in margins was primarily driven by higher input cost, including higher commodity and packaging costs, and a sharp surge in power and fuel expenses. Among all business segments, merchant ENA reported the strongest volume growth of more than 24%. However, revenue growth for the segment lagged on account of soft realization. While IMFL licensed brands grew over 10% in volume terms, the IMIL business was largely stable with very little change in revenue and volume. A combination of weak sales volume and adverse product mix weighed in on the operational performance of the proprietary IMFL business. The company operated at optimum capacity utilization during the quarter. To fuel the next leg of growth, the company plans to enhance its capacity to 7.5 crore litres per annum along with cogeneration power plant. The capex outlay for the project is pegged at 110 to 120 crores. From the incremental capacity, company will initially be focusing on ENA sales to grab the ethanol market opportunity. To expand its domestic presence, AABL forayed into the IMFL segment through the launch of proprietary brands. IMFL brands are currently being sold across 6 states, and the company intends to further enhance their distribution reach to newer states in the coming years. During Q2, AABL also entered into a strategic tie-up with a bottling unit in Kerala to cater to the demand of premium products. AABL is a well-managed business with stable operating cash flow. The company manages working capital efficiently, which aids robust cash generation. In H1 FY22, it generated operational cash flow of 58 crores. The balance sheet is solid and the cash position at the end of September quarter was close to 90 crores. The cash on the balance sheet will be primarily used to expand capacities and augment its distribution reach. Its margins in the recent quarters have been eroded by higher raw material prices. Near-term macro headwinds, whether it's surge in oil prices, global slowdown, etc., further cloud the margin and growth outlook. Although margins may be under pressure for the next 6 to 9 months due to inflation, in the medium to long term, we expect the company to become more profitable as it expands scale on the back of capacity expansion. The stock has corrected about 30% from its all-time high in October 2021 and is currently trading at an FY23 PE ratio of 11x. Investors therefore should look to accumulate the stock of Associated Alcohols at the current levels as the valuations are very reasonable and the business offers decent long-term potential to generate alpha for all the stakeholders.